You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. In today's show, you're going to be hearing from a veteran resource investor, fund manager, Adrian Day from AdrianDayAssetManagement.com. As I've said many times in the past, the first book I ever read on resource investing was written by Adrian over a decade ago. So Adrian, welcome back onto the show. And I'd like to pick your brain by seeing how you're managing the funds under management as it relates to those money you've been given to invest in the resource and gold and silver sector. How are you managing? Are you going to cash? Are you deploying? Are you fully deployed? Can you give us a little insight here, please?
Sure, absolutely. And Bill, thank you very much for having me. I appreciate it. I know you said how we're managing the money with regard to those sectors, but we manage money across global markets. So, and then we also have dedicated gold and resource accounts. Now, clearly, if someone gives you 5% or 10% of their portfolio dedicated to gold, that person tends to want to be invested. If a person gives you $500,000, that's all their portfolio for a conservative global account, I don't have to buy gold or resources if I don't want to. So so that's a distinction to make at the beginning. It depends an awful lot on the client, to be honest. But, you know, right now, I would say we're pretty fully invested with our gold and silver allocation, whatever that means. If someone gave us money for gold, we're fully invested in the global accounts, whatever allocation we have for gold and silver. We're pretty full right now. And I'll admit, perhaps we did a reasonably good job at trimming some positions in February and March, but we bought back far too soon. And, that's not uncommon for value investors. So we're fully invested there. In the resources generally, I tell you, it really varies from one to the other. But generally speaking, we've got a lot of dry powder available for other resources. And that would include everything from, energy to, well, uranium is energy, everything from the energy sector to the base metals, agriculture and everything. So we're invested, but we've got a lot of dry powder there.
And would you keep the dry powder for fear of a recession and a further sell-off? Or what would be the rationale between keeping a lot of dry powder right now?
It really depends on the commodity, but generally there'd be two things. One would be the recession, particularly a recession in China, which remains, the dominant demand source for most resources. That would be number one. And then number two would be the war in Ukraine. If or when that ends, I think there'll be some sell-offs in some of the commodities that have responded particularly positively to that event. So, for example, oil and gas. If the Ukraine situation, ended tomorrow, whatever happens with broad sanctions against Putin and everything else, I think the sanctions on Russian oil and gas would be lifted pretty quickly, because that's what the West needs. And in that case, I think the oil and gas prices could drop fairly significantly very quickly. Now, longer term, I'm bullish on both of those, very bullish, in fact. But I'm waiting for those events.
So in your experience, as commodity investors, I think, as you alluded to, we can often be too early. How do you define being too early equating to being wrong? Like when you do your self-assessment, can you give any examples maybe from your own investing career?
That's a good question, because of course, sometimes being too early is just a euphemism for being wrong. I think a lot depends on the time frame that you gave yourself when you made the investment in the first place. So if I buy Franco-Nevada, for example, or Nestle outside the resource area, which I'm buying as a long-term investment for long-term exposure to those various sectors or areas, with a reasonable dividend in both times, but with dividend growth in both cases. It's a long-term investment. Well, if the stock goes down for 6 or 12 months, that doesn't really detract from the thesis. If I bought Ajax Exploration because they had some drill program coming out, well, if I'm wrong by 2 weeks, then that's a mistake. So I think a lot depends on the time horizon and the objective for which you bought something.
What about the gold stocks and gold sentiment, Adrian? Based in your historical perspective, you've been at this quite a bit. How do you rate sentiment right now?
It's interesting. That's a really interesting question. Certainly among generalists, sentiment towards gold and silver is worse than the negative. They just don't care. So the sentiment among generalists, I would say, is pretty much the worst I've ever seen. And we might get into the generalist a little bit later. With regard to gold investors, I think there's a bit of, I'm seeing two types of people. I'm certainly seeing newer investors who are saying, by newer, I mean the last, 2-3 years. As you can tell from my comments, I tend to take a long-term approach to things. Certainly seeing newer investors who regret ever having bought gold and silver. Why did I ever get involved in this market? Now, typically, as we were discussing beforehand, and this is not a criticism of the investors, typically these are people who chase performance. I know when I look at my managed accounts over 30 years, I've been doing it 30 years now, we tend, when we get clients close, other than, deaths, when we get clients close, I would say the vast majority of those are people who've only been open a year or two. And then when you look at it, you see, oh yeah, we had really good performance in, 1987, and they all closed in 1999. But people who've been around for a while, they've seen the cycles, they understand the inherent volatility, and they tend to be a little more tolerant. So with regard to sentiment now, there's no question that the people who have, what we'll call, dedicated gold investors are frustrated that gold hasn't gone up more given the inflation and given the war. But I think over the last few months, as more and more people, including myself and you, have begun to explain why gold is where it is and why it really isn't as bad as, it might look on the surface, I think people have become a little more comfortable or accepting of that. For
generalist inflow into the sector, I've had some recent guests say that we need to see the generalist investor give up on general equities. Just say general equities are in a bear market and search for value elsewhere, other places, other sectors. Also, some guests have said we need to see all-time gold prices, break through our previous high of a couple of years ago. Those are two things from your analysis. What do you think needs to happen to see generalists flow into this sector, Adrian?
Yeah, I think both of those are right, or both of those are true to some extent. I don't necessarily think we need to see the broad market collapse, but we certainly need to see the broad market, stop going up and people start to rotate. There's already been rotation from the tech stocks, tech growth stocks into the value stocks, and more defensive stocks changed a little bit in the last, few weeks, but we were seeing a lot of that rotation. And I think, a decline in the broad market, not a collapse, we'll see rotation into gold. I definitely think we need to see the gold price higher on a sustained basis. And it doesn't necessarily have to be new all-time highs, but if we start getting over 1,800 and 1,850 and then 1,900, to me would be a trigger for a lot of interest to come back to the sector. But it has to sustain it. With regard to the gold stocks, the gold equities, I think there's one other factor, and that is, the generalist wants to see consistent performance. And, those of us who are in this sector, we know we know that the gold market and particularly the equities are inherently volatile. You can't get away from that. It's a very volatile business. It's also a very risky business. We know that. And, it's only going to get worse, in my view, as time goes on. We've already got we haven't got all of them. That's not quite true. But certainly Nevada, for example, has been well picked over. And, where are you seeing the really big deposits now, whether it's gold or copper? You're seeing them in the Congo or you're seeing them in Pakistan. Well, the generalist is just not comfortable with some of those places. In addition, those places give you not only additional risk, but they give you constant headline, stomach aches, whether it's coups or new taxes or, not letting the money out of the country or whatever it is. So again, if you're in the business, you're accepting of that, even if you're not comfortable of it. If you're a generalist, and you're used to investing in Nestle, for example, buying stocks that go up and down by 30% in the space of a couple of months is just not something you can accept. And I think that's one of the reasons why generalists have become increasingly comfortable with the royalty and streaming companies, which, although they're not immune to volatility by any means, again, we know that, but they're not immune to it, but they're certainly a lot less volatile, and they're a lot less volatile on a very short-term basis. So the generalist is more accepting of that.
Do you think the balance sheets of the major gold producers play a role in drawing in generalists as well?
Yeah, I mean, well, when you look at it right now, the balance sheets are very strong. The XAU, Index of Senior Gold and Silver Companies, is net cash positive, which is astonishing for a capital-intensive industry. Now, that includes a royalty company, so the miners are probably not net cash positive, although some of them are. Barrick, for example, is net cash positive. So they have very strong balance sheets. The dividend yields are higher than the S&P, and the multiples, the earnings, cash flow, book value multiples, are better than the S&P, which is the first time I've ever seen that. And I think that goes back to your question of what will get people to come in. When the broad stock market starts going down, people start pulling up doing screens on Bloomberg and saying, show me the highest dividend payers. Oh my gosh, Barrick's paying 5%. It'll come as a huge shock to a lot of people. And where are the lowest cash flow multiples? My gosh, for gold stocks. So I think when the market comes down, people will start to appreciate the value that there really is, the true underlying value, not relative value, historic value, but the real value there is in the gold stocks.
What are some of your winners and losers from Q2 earnings from the gold producers? Can you share just maybe some snippets or highlights that you?
Yeah. Production was more or less in line for most of the major companies. There were a couple of sort of exceptions, but production was more or less, wasn't out of line. Costs, of course, were up as we would expect, but for some of them, like Newmont or Kinross, it was a lot more than expected, and a lot more than other companies. Like Agnico, for example, which actually improved their costs, although part of that was just because of synergies from the merger with Kirkland. But nonetheless, some of the companies, Barrick, wasn't so bad, but Agnico actually improved it. The other thing we should look at, and I'll come to specifics in a minute, is that the margins, a lot of analysts and a lot of investors have been disappointed with some of the earnings, but let's not forget, when talking about cost pressures and so on and so forth, but right now, certainly the second quarter margins, really quite good. If you're looking at $1,250 as all-in sustaining costs for many of the companies, and you're looking at $1,700, $1,750 gold price, these are very, very attractive margins. We've seen the cost increases. The big problem with cost increases is not just, it's another 5% we weren't expecting. but it can cause problems at marginal mines. So you saw, for example, Pan American. They've stopped mining the underground at Dolores, which is one of their larger mines. Although it's got a limited mine life ahead of it anyway. It's coming towards the end of that. But the cost pressures were one of the reasons that went into that decision. There were others, but that was one of the factors. And so I think you can see more things like that happening, where cost pressures will be a factor in determining whether to do an expansion or whether to delay it, whether to close a mine a little earlier, or whether to do an acquisition for that matter. And again, I hate to be sound like a broken record, but this last quarter gave us a perfect example of why, people like royalties and streamers. Because the royalties and streamers, by and large, had very, very strong quarter. And in Wheaton, of course, was hurt by Vale Salobo, where production was down 39% year on year. But the others, and they had a good quarter, but just not a great quarter. But the other royalties all did very well, and most of them, Cisco, Franco, Royal. They had records on many financial metrics, even though many of the miners didn't. So, again, that's why a lot of people just stick with the royalties and streamers.
For historical perspective, Adrian, when I look at all of the failed mine builds and CapEx overruns over the last 2 years, does this seem like it's occurring on an above average relative to your experience in the sector in the last 2 years?
Yeah, I think you're right there. Look, historically, there is a long history of mining companies, and maybe even particularly gold and silver, gold companies, having overruns and delays. There's a long, long history of that. But I think the last couple of years have certainly seen an increase in that, and for many reasons. Obviously the inflation, cost inflation, price inflation that we've seen. If companies made a build budget, 2 years ago, they weren't, or 18 months ago, they weren't planning for 9.5% increases in different prices, and more than that, of course, in energy and steel. They weren't planning for that. So that's definitely one factor. We've also had incidences where the supply chain disruptions have hurt. Companies like Barrick, had to delay the Pueblo Viejo expansion, and one of the reasons was just inability to get very, very specific but necessary parts for the machinery. So yes, you're seeing some of that. I think some of the most, if you look at IM Gold and Cote, I don't know that has anything to do with inflation or supply chain. I think that was just how can I put it diplomatically? I think that was just an over-optimistic build, plan that maybe hasn't been executed too well. So, but that's an extreme case. But I certainly agree with you. We're getting a lot more of that. Yeah.
What's your expectation for like zinc, nickel, aluminum in the face of a potential recession? How are you approaching investing in these commodities?
Yeah, well, those commodities, but really all commodities and resources even, they will be most affected by China. China remains the dominant source of demand for all those commodities. And of course, prices are set at the margin. So if a recession causes a 10% decline in demand from China, then that has a fundamental impact on the price. I think a lot depends on the individual commodity. I favor commodities not only where you can see a clear demand pattern and growth, and particularly where you can see new sources of demand, such as with copper and electrification. You see a new source of demand, but and silver with solar panels and so on, but also where there are genuine difficulties in increasing supply. So I look as much at the supply question as I do at the demand question. And if you look at the supply side, it would seem to me that things like copper have a very, very strong profile, whereas maybe iron ore, now there's a shortage of high quality green iron ore, but there's no shortage of iron ore. And if the demand doesn't care which one they're buying, they will go for the cheaper. They'll go for the cheaper one, that's non-greens. So I think a lot depends on the individual commodity. And then you have some, like, let's say, oil is a good example where, once we get the war, once we put that aside and that's over with, I think there's a difficulty in boosting supply meaningfully on a sustained basis for a lot of reasons, practical reasons, technical reasons, but also political reasons, of course. So I think it's different for each commodity. But certainly if the world goes into a recession, particularly if it's a China-led recession, that will have a negative impact on all of the commodities.
So if you're still bullish oil over an extended period of time, do you have a target price for oil where you might be nibbling at some of these oil stocks?
Yeah. I mean, the oil and the oil stocks, as you know, have come off a little bit certainly from their highs. But, I'm still nervous that once the war stops, the oil price could go down to $70 or something like that, and the oil stocks would follow immediately. Now, would that be long-lasting? Probably not very long-lasting, because the fundamentals for the oil market remain very, very positive. And of course, if the war stops and the sanctions are lifted, there'll be a lot of rebuilding of inventory and stockpiles in oil and gas, right? Because they're all depleted in Europe at the moment. So there'll be a lot of immediate rebuying. So that would be my trigger, I think, rather than a specific price. We did buy some oil stocks, not as many as I would have liked, but we did buy some oil stocks at the beginning of the year. But I've sort of got out of most of them at the moment.
And Adrian, last question for the second half of this year. As you assess the biggest risk for resource investors, would it be a recession or is it something else?
Well, there's always black swans, which by their nature, you don't know what they are.
Or can't predict them, right?
But I think the recession would be the most obvious known risk. Yeah.
Okay. Well, we'll leave it at that. Your website is adriandayassetmanagement.com. That's the best way for people that want to get in touch with you to get in touch with you?
Sure. Yeah, I mean, I can give you the email. That's assetmanagement@adrianday.com.
Okay. And go to Adrian's website. You'll see a lot of his interviews that he's done, some articles, and he also has a subscription service too at that website. So Adrian, I really appreciate your time. Thank you for sharing your insights on today's show.
Well, thank you very much, Bill, for having me. Appreciate it.